Hello everyone, welcome back to Gold Rush Reporter. Before we dive in, make sure you hit that like button, subscribe, and click the notifications bell so you never miss a market update. Today, we're discussing something monumental in the silver and gold markets, how the physical market is taking control, and why the paper markets are losing power faster than ever. Let's start with the basics. Both gold and silver have been overbought, but silver is more overbought than it was during the historic 1980 peak. And yet, despite these high levels, we aren't seeing a crash. What we're seeing is high-level consolidation, markets breathing, coiling, and preparing for the next big move. Here's the key. The paper trade is waning, and physical markets are growing. You can see it in real time as BRICS nations open storage facilities, build refineries, and aggressively accumulate gold and silver. For decades, these countries held massive amounts of dollars on their balance sheets, but now they're swapping fiat for real, tangible money. This is a structural shift, not a short-term trend. Why does this matter? Because we are in a structural deficit. For 5 straight years, supply has lagged behind demand. Global silver production is only around $30 billion annually, a small market relative to the scale of global capital. In a market this size, it's easy to manipulate prices downward, but long-term consequences are unavoidable. When prices are suppressed too low, miners reduce production, investment dries up, and reserves shrink. This is why the structural deficit persists and is unlikely to reverse anytime soon. Other indicators are pointing toward the same reality. Lease rates on silver are spiking, and borrowing costs for shorts, especially on ETFs like SLV, are blowing out. These are signs that short positions are under stress, and a massive short squeeze is building. And here's the thing. Once the squeeze happens, the numbers for both gold and silver are likely to far exceed the most optimistic forecasts. Anyone giving you a target price is probably underestimating the upside. Why? Because paper contracts have been sold against metal that doesn't exist. When delivery is demanded, that illusion collapses. People will want real metal, not IOUs. And the scale of capital waiting to move from stocks, bonds, and even crypto into precious metals is trillions of dollars. Silver, being a small market, is especially vulnerable to explosive moves. Physical silver isn't just a hedge. It's a monetary tool with real utility. Unlike gold, which is mostly money, silver has industrial, technological, and even medicinal uses. It's been used for centuries because of its antibacterial properties, giving rise to terms like born with a silver spoon in one's mouth. This means silver is both money and functional commodity, making it fundamentally more versatile than gold. We're seeing a regime change unfold. For decades, the paper market dictated pricing, and as long as no one asked for delivery, the system held. But now buyers are demanding metal, backwardation is appearing, and premiums for physical silver are rising. The casino of paper contracts is losing control. And the transition is not polite. It's a forced takeover. In short, the silver market is evolving before our eyes. The physical market is taking command, paper contracts are losing influence, and consolidation is setting the stage for a massive acceleration. Picking up where we left off, let's dig deeper into the physical versus paper dynamic in the silver market and why it's creating a seismic shift. For decades, the price of silver was largely dictated by paper contracts, futures, ETFs, and digital IOUs. These contracts promised metal that didn't exist in reality. As long as traders didn't demand physical delivery, the system functioned. But now, that illusion is breaking down. Buyers are increasingly demanding actual ounces, and the paper market can no longer keep up. This is visible in rising lease rates, borrow costs, and backwardation. situations where the current spot price is higher than futures prices. In a normal, healthy market, this shouldn't happen. When it does, it signals stress in the system and the growing dominance of the physical market. Backwardation is particularly important. In silver, backwardation has appeared subtly, but consistently. It means metal today is more valuable than a promise of metal tomorrow. That's a flashing red light for anyone trading paper. Investors are no longer trusting IOUs. They want tangible metal in hand. This is why premiums for physical silver are rising globally, even when the US spot price dips. Markets in Shanghai, Dubai, and other key hubs are paying much higher than paper prices, reflecting true scarcity. One of the clearest examples of this shift is junk silver. For years, it was the easiest way for Americans to accumulate real silver. Coins like dimes, quarters, and half dollars minted in 1964 or earlier contain 90% silver and are universally recognized. Today, junk silver is trading at discounts below spot due to temporary refiners' backlogs. But once refiners catch up, prices will normalize or even spike above spot. For US investors, junk silver represents the most liquid, smallest, and most practical units of silver. Unlike large bars, which are difficult to use in everyday transactions or barter scenarios, junk silver is divisible, recognizable, and portable, making it the ideal physical holding. The structural deficit compounds this advantage. For 5 straight years, demand has exceeded supply, with much of today's silver being a byproduct of other mining operations: copper, lead, zinc. When prices are suppressed, miners reduce output and production collapses. Unlike commodities you can grow or extract quickly, silver is finite and non-expandable in the short term. Combine that with the aggressive accumulation by BRICS nations who are building refineries, vaults, and clearinghouses, and you see why physical silver is now the real driver of market value, not paper trading. This shift has geopolitical implications too. BRICS accumulation isn't subtle. They're creating independent physical systems outside Western custody. Gold and silver are now serving as new collateral systems for a large portion of the world. This reduces dependency on US dollars and Western financial infrastructure, accelerating the transition away from paper dominance in precious metals. For the everyday investor, these shifts highlight a critical takeaway. Physical silver is becoming the only reliable store of value. The paper market is losing authority, backwardation signals stress, premiums are rising, and small divisible units like junk silver are undervalued. Those who hold physical metal are shielded from the structural instability of paper markets and can benefit from the next leg of the bull run. Even though charts may show consolidation, the physics of scarcity tell a different story. We're in the middle of a regime change, a forced takeover of the silver market by real, tangible demand. The consequences of ignoring this shift are profound. Investors relying on ETFs, futures, or digital claims risk being left with contracts that may never be fulfilled in a crisis scenario. In short, physical silver is taking command, junk silver is undervalued, and backwardation plus rising premiums are signals that the paper market is in decline. This isn't a gradual evolution, it's a rapid transition, and understanding it now is key for anyone looking to preserve wealth and profit from the next stage of the silver bull run. Continuing our analysis, let's focus on why silver is uniquely positioned to explode in value during the next financial crisis, and why understanding global leverage and systemic risk is critical. We've talked about physical versus paper markets, backwardation, and junk silver, but now it's time to step back and look at the big picture. Global markets are highly leveraged and the cracks are widening. Sovereign debt, corporate bonds, and the stock market are all heavily dependent on trust in paper promises. When confidence collapses, money flows toward real, tangible assets, and that is where silver comes into play. Look at the US and Japanese bond markets as a case study. Japan spent decades keeping interest rates at zero, enabling massive carry trades. Investors borrowed yen at negligible rates and deployed that capital globally, inflating stocks, real estate, and crypto. But as rates in Japan rise, that entire structure begins to unwind. Investors must sell US assets, convert dollars back into yen, and repay loans. This creates selling pressure in the US and buying pressure in Japan, generating a self-reinforcing feedback loop. Now consider the scale. Japanese institutions alone hold over $1 trillion in US treasuries. They are no longer buyers, they are sellers. When major holders dump US debt, long-term yields rise regardless of Federal Reserve actions. Even if the Fed cuts rates, yields stay elevated because global leverage is working against it. This is a systemic imbalance, one that threatens the stability of the dollar and paper-based financial instruments. This is exactly why the physical precious metals market is seizing control. Ordinary investors, recognizing the fragility of financial instruments, are demanding silver and gold they can hold in hand. Central banks are buying gold, but silver is for the people. Governments accumulate gold for trade, currency backing, and international credibility. Silver, however, is money for daily survival, liquidity, and flexibility in a failing system. Here's where it gets really interesting. Silver is both monetary and industrial, which makes it unique among commodities. Gold is strictly money. Silver serves as money and is essential for electronics, solar panels, medicine, and technological applications. Combine that with the shrinking supply due to structural deficits, and you see why silver is the most undervalued asset relative to its potential. Physical silver can't be printed, unlike paper contracts, so any surge in demand has instant, extreme effects on pricing. The current market also shows clear signs of a massive short squeeze. Lease rates are spiking, borrow costs are blowing out, and backwardation is appearing. These are classic signals that the paper shorts are under stress. Once enough participants demand physical delivery, paper contracts become worthless. This will force institutions to cover positions at any cost, sending prices sharply higher. Meanwhile, junk silver remains a hidden opportunity. It's the smallest, most divisible unit of silver, universally recognized, and impossible to counterfeit if minted pre-1965 at 90% purity. While refiners are temporarily creating a backlog, the discounts below spot present a rare buying window. Once the backlog clears, these discounts vanish, leaving only the supply-conscious investor with access to this essential asset. What we're witnessing is not just a market trend, it's a structural transformation. The world is moving from a paper-based illusion to a reality-based metal system. Investors who recognize this now will benefit the most when the next phase of the bull market accelerates. In short, systemic financial stress, global leverage unwinding, the scarcity of physical silver, and the undervalued state of junk silver are converging. The physics of scarcity, combined with a global shift toward real assets, makes silver poised for dramatic gains. The next leg of the bull run won't be gradual. It will be explosive, fueled by fear, scarcity, and real demand. Let's continue and focus on the structural forces driving silver higher, including deficits, BRICS accumulation, and why physical silver is now dominating the market. One of the most critical points is the structural deficit in silver. For 5 consecutive years, global demand has exceeded supply. The world consumes roughly 850 million ounces annually, yet mines only produce enough to cover that demand partially. Much of today's supply comes as a byproduct of mining other metals, copper, lead, and zinc. When prices are suppressed, miners reduce output, causing production to fall even further. Unlike wheat or oil, silver cannot be grown or drilled quickly. It's finite. This scarcity is the fundamental driver of long-term price appreciation. Now, combine this with BRICS nations' strategic accumulation. For decades, these countries amassed large dollar reserves. Today, they are diversifying into physical gold and silver, building storage facilities, refineries, and independent clearing systems. They are no longer dependent on Western custodianship or COMEX and LBMA pricing. Physical precious metals are becoming a new collateral system, reducing reliance on the dollar and Western financial networks. This institutional demand adds enormous upward pressure on prices, especially for physical silver. The shift from paper to physical is another game changer. Paper contracts, futures, ETFs, and other derivatives once set the market's pricing. But with rising demand for actual metal, paper markets are losing influence. Backwardation, rising lease rates, and elevated borrow costs indicate that the paper shorts are under extreme stress. Once enough participants demand delivery, these contracts risk becoming worthless. This is why the market is now physical-driven, and the transition is not orderly, it's forced. The institutions that dominated paper markets are losing control, and the market is adjusting rapidly. An essential aspect for investors is junk silver, which has temporarily collapsed below spot prices due to refiners' backlog. Coins such as pre-1965 dimes, quarters, and half dollars are 90% silver, divisible, universally recognized, and impossible to counterfeit. They are ideal for everyday transactions in a crisis scenario, unlike large bars. This temporary price gap is an opportunity. Once refiners catch up, junk silver prices will return to or exceed spot, making today's buyers extremely well positioned. We also need to consider the psychology driving this market. Fear is the dominant motivator. Investors are not buying silver for speculative greed. They are buying for protection against systemic risk. Stock markets, bonds, and even crypto are vulnerable to defaults and liquidity crises. Physical silver provides a hedge that is tangible, divisible, and universally recognized. This is why silver, despite being smaller in market size compared to gold, can experience explosive gains during crises. Another structural element is the interaction between global leverage and trust in fiat systems. Countries like Japan and the US have created complex carry trades and leveraged financial networks that are now unwinding. When foreign holders sell US treasuries or other paper assets, interest rates rise and trust in fiat weakens. Investors respond by moving into tangible assets like silver and gold. Physical silver benefits the most because it is both a monetary refuge and an industrial necessity. Finally, it's important to recognize that these forces, structural deficits, geopolitical accumulation, physical demand, and systemic fear, are converging simultaneously. This is not a gradual market cycle. It's a structural realignment. Physical silver is no longer a side market. It is taking command, and those who ignore it risk being left behind. The bull run is not just a trend. It's a regime change, moving control from paper traders to holders of tangible, deliverable metal. Now, we arrive at the final part, where we tie together everything that's happening in silver and gold markets and discuss what it means for investors, stackers, and anyone who wants to protect wealth in the coming financial turbulence. The key takeaway is that physical silver has taken control. For decades, paper markets, futures, ETFs, and contracts dictated prices. But today, more investors are demanding real metal, and paper promises are failing to meet that demand. Backwardation, elevated lease rates, and declining inventory reports all signal that the system of paper silver is breaking down. This isn't a small blip. it's a structural shift. Once enough investors demand delivery, the paper contracts will lose credibility and prices for physical silver will surge sharply. For the individual investor, the lesson is clear. Stack physical silver in forms that are practical, recognized, and liquid. Junk silver remains one of the best options. Pre-1965 dimes, quarters, and half dollars are 90% silver, divisible, widely recognized, and impossible to counterfeit. They are transaction-ready, meaning they can be used in barter or small exchanges in a crisis scenario. Unlike large 100-ounce bars, these coins are practical and provide flexibility if the system begins to fail. Right now, dealers are offering junk silver slightly below spot due to refiners' backlogs, creating a temporary buying opportunity. Once the backlog clears, discounts will vanish and prices will normalize or spike. Beyond junk silver, consider stacking recognized bullion coins like American Silver Eagles, Canadian Maple Leafs, or Austrian Philharmonics. These coins are globally recognized, easy to trade, and highly liquid. For gold, small units like 1-ounce coins provide similar advantages: recognized value, portability, and security. The strategy is simple. Convert paper wealth into tangible, deliverable assets that cannot be frozen, rehypothecated, or seized in a financial collapse. The bigger picture driving silver is systemic risk and fear. Stock markets, bonds, and even crypto are vulnerable to defaults, liquidity crises, and leverage unwinds. Physical silver is uniquely positioned as both a monetary refuge and an industrial commodity. Its dual role magnifies demand during crises. Gold serves as money between nations, but silver is money for the people. When trust in fiat collapses, ordinary investors will seek tangible protection, driving silver prices dramatically higher. We are also seeing geopolitical forces play a role. BRICS nations and other global players are stockpiling physical silver and gold, building infrastructure to ensure control outside Western custody systems. These moves are accelerating scarcity and reinforcing the shift from paper to physical. The market is no longer just about trading, it's about control. The physical market has become the dominant force, and paper markets are secondary. The structural deficit remains a major factor. Mining cannot meet global demand, and a significant portion of silver comes as a byproduct of other metals. This means that production is constrained. When you combine shrinking supply, rising demand, and systemic financial stress, the physics of scarcity drive exponential upside potential. Historical patterns, like backwardation and elevated lease rates, confirm that this isn't speculation. It's structural. Finally, risk management cannot be overstated. Stack small, recognizable units of silver, maintain a diversified precious metals position with gold, and stay informed. The next phase of the bull run will likely be volatile, explosive, and unforgiving to those who are unprepared. Investors who ignore physical silver risk, missing the most powerful monetary and industrial asset surge in modern history. In conclusion, the lessons are clear. Paper is dying. Physical is taking control. Junk silver and recognized bullion coins are your best defense. Structural deficits and global accumulation drive scarcity. Silver's dual role as money and commodity amplifies demand. Fear, not greed, will drive the next leg higher. This is the moment to act decisively, secure your tangible assets, and position for a historic bull run in silver. The era of paper dominance is ending, and the age of physical silver is here. Stay tuned, stay stacked, and stay ahead of the curve. Check out Summit Metals in the description to buy or sell, and as always, like, share, comment, and subscribe for the latest updates.